All right, my name is Ken Abbot. I'm what's called a distinguished lecturer in the law department. That means I'm an academic in the civilian military. I don't have a PhD, but I do have 35 years of experience. I was a managing director at Bankers Trust, Bank of America. I spent 9 years at Morgan Stanley, and then I was America's Chief Risk Officer at Barclays before I left. I have an undergraduate degree from Harvard and 2 master's degrees from NYU. And I love this business. This is what I wanted to do, and I did it for a long time. And then I decided I didn't want to do it anymore because I didn't want the stress because it's a young person's game. And now I'm a teacher, and it's the best job I've ever had. So last time we spent about an hour and a half talking about why you might or might not want to be in finance. I told you that, yeah, it's a good way to make a lot of money if you're good at it and you like what you do, but there are a lot of people that go into it for the wrong reasons. And we spent a lot of time talking about the different types of attributes. Today, I want to talk about some different topics. Today, I want to talk about the types of jobs that are there, both in the front office and the back office. And then we'll probably break this into 2 parts, and we'll talk about the types of companies that are out there. Because it's one thing to know that you want to be a trader, but then it's, do you want to be a trader at an investment bank, at a universal bank, at a broker dealer, at a commodity dealer, at a hedge fund? Those are different types of companies. So it's a different discussion about what the difference is between an investment bank, a commercial bank, a mutual fund, a hedge fund, a private equity firm, an insurance company, a mortgage broker. So that's a key part of understanding the job market, is understanding who these companies were. And another reason I do this is I was completely clueless when I was your age. And the story I always told is that I would write letters that are basically saying, well, I'm not sure whether I want to be a truck driver or a prima ballerina. And it's okay to be interested in several things, but when you communicate with people at these companies, you need to be focused about what area you're speaking about. You don't want to talk about private equity and municipal finance, because that's chalk and cheese. Those are completely different businesses, require different skill sets. So what I want to talk about today is sort of the types of jobs and the things that people do. A lot of this material I developed for a couple courses. One course I teach on control functions. I teach in the fall. And the second course, and that is the supporting functions for sales and trading, investment banking, private equity, et cetera. For every job in the front office, there are anywhere between 2 and 10 jobs in the middle office and back office. And most people end up working in those types of jobs, at least for part of their career. And this course talks about what those functions do. And the second course I teach is in the spring. It's on the regulation of products and markets. And in order to talk about the regulation of products and markets, we have to talk about what those products are and what those markets are. And so I divide the financial world up into a set of products and a set of different markets, which all have their own individual characteristics. So if you have questions, post them to the Zoom chat. I'll try to keep an eye on that and see if anything interesting comes up. If I don't see anything that's germane to the discussion, we'll keep it to the end. My email is Abbott, K-A-B-B. Here, I'll post it. There it is. To everyone, you can feel free to email me. I've had a lot of success helping kids get jobs. If you look at my Rate My Professors page, you'll see that that's generally what people have said. Because I hired hundreds, maybe thousands of people over the year, I kind of know what interviewers are looking for, and I know the kinds of things that you have to know. In fact, anecdotally, several students in the past year weren't sure about the types of interviews they were getting. And so we sat down, we talked about the types of companies, the types of jobs, and they said that was a key part of how they got their job. And I'm happy to do that for an interview, not just for the people in my class. You can always call me. If you don't hear back from me, contact me again. I get a bunch of emails. Sometimes I miss stuff. Somebody asked about my FIN 3093. That is a course on control functions, and we'll talk about that there. I think the finance cohort, it's split between law and finance. I think the finance cohort is filled up, but there's still plenty of spots open for the law course as far as I know. But you guys let me know. All right, and I'm happy to help. So now I'm gonna share my screen. And I'm going to use these slides. Now, about a third of these slides are slides that I got from Kara, and then I went in and I added a whole bunch of material based on my experience. And one of the things I'll talk about just as we get started, it's hard to come up with one definitive way of dividing up the world of finance, because there are many different ways you can cut it, by product, by institution type, by country, by industry. There's all kinds of different ways you can look at it. This is one particular cut, the one that I think is particularly useful based on my experience. All right. So, what is finance? Things like, how do we pay for new equipment? Do we issue equity? Do we issue bonds? Do we borrow money? Do we take money out of our cash account to do that? If I'm buying a company, how much do I pay for that company? How do I determine what the appropriate amount is? Well, there's set ways to do this. There are established techniques that say this company's worth so many $1 million. When I'm making a loan, if I'm in the commercial banking business, I have to first of all figure out whether I want to make the loan. How do I make that loan? And another question is, how do I calculate the estimated loss so I can get an estimated risk-adjusted return on capital calculation? And the fourth thing here is, when I look at the way things trade in the markets, how do I make intelligent assessments of the individual securities, commodities, and currencies that are available to me in order to make intelligent investment decisions? So these are among the types of questions that are asked. Now, we talk about career areas. There are many different areas within finance, and this is one particular way of looking at it. You got people that need capital. You have people that have capital. Capital being money in the form of either debt or equity financing. So who needs money? Public companies need money. Public companies need to borrow from the markets in the form of debt. Public companies need money in the form of equity. They want to share their ownership of the company. So they go to the capital markets as the intermediary to raise funds. Private companies and individuals also go to the capital markets. Might be for loans, could be for initial public offering, could be in what we call the private equity market, where companies that are not listed can trade ownership shares or buy or sell ownership shares, buy or sell other companies. Very active business in private equity. Governments and agencies also need to borrow money. So we see this most commonly in the U.S. government bond market, one of the biggest bond markets in the world, and federal agencies, as well as state and local governments. They go to the capital markets. So when we look about people who have the money to invest, we have institutional investors. We've got pension funds. We've got mutual funds. We've got real estate funds, private equity funds, college endowments that have money to invest. And they often look for long-term, sometimes short-term, but frequently long-term investments. You have retail investors, mom and pop, who want to buy stocks. More commonly, mom and pop are invested in stocks through their 401ks, through their IRAs, through their 529, which are tax-advantaged college investment instruments, and also through retail equity markets as well, through mutual funds. You have governments and agencies that also have amounts to invest, and sometimes you'll get the mandate to manage a certain agency's money. So that's another thing that happens. So the capital markets is sort of the nexus, the hub where all this activity takes place. I'm hoping that most of you are kind of more or less familiar with this, because if you're in a business school, if not, that's okay. If you have questions on this, I've posted a lot of stuff to quantnet.com. Well, I'm not being paid by them. I just use it as it's a blog. And if you go into books, I posted a lot of introductory material, readings and videos that I found useful, as well as a lot of stuff on risk management. If anybody is interested, you can look for the stuff I post there. I try to update it on a regular basis. So obviously, you have a lot of different types of institutions when we talk about the business. The ones we most commonly think of are the universal banks, like JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America, Barclays. They do broker-dealer, they do commercial lending activity, they do investment banking, they do asset management, they do funds management, they have their own mutual funds, they do custody services, they provide a whole bunch of different types, but there are many, many, many other types of firms that are involved. And we'll get to that a little bit when we talk about it. So we talk about why institutions hire, and we talk about what kinds of people they need. Well, what do they need? They need people to look at their market risk, how much money they can lose based on moves in the markets. They need people to look at credit risk positions, how much money they could lose if people choose not to pay them back, either because they're unwilling or unable to pay back. They hire a lot for technology positions. And when we say technology, it's not necessarily a hardcore development where people are sitting in black rooms whose skin is basically a light blue from lack of sunlight. No, that's not what technology is about anymore. It might have been that way in the 60s and the 50s, not that way anymore. Technology is an active part of the business. I would argue it is the most crucial part of the infrastructure behind any Wall Street business, and the companies that have succeeded have generally succeeded, at least in part, sometimes completely based on superior technology. I would argue that Goldman and Morgan Stanley have better technology than most. I would argue that a lot of the other big banks have dismal technology. And I can tell you with 100% certainty that when and if you join the financial community, one of the things that will shock you is the appalling general state of technology in the markets and how bad it is. Most firms have very siloed, but that's another story. You have operations. Operations is very different from technology. Operations is the plumbing. How does position data get from the point where it is booked in the system to when it shows up in the general ledger? How does it actually get booked so people can analyze it? Finance, and I'll talk a little bit about that, is scorekeeping. It's the accounting side for the most part. When we say the field is generally known as finance, but this is an important distinction. When you talk about a position in finance in a bank, you're generally talking about an area in the accounting practice of the bank. So be careful. When somebody says finance, the question you want to ask is, do you mean finance accounting, or do you mean finance as a general description of all businesses dealing with financial assets? Important distinction to be made. Compliance. Compliance, how do we know we're following the rules we're supposed to be following? I've got a slide on that. We can talk about that later. Legal, how do we make sure we're following the right regulations? How do we make sure our conduct risk is good? How do we make sure our contracts are enforceable? Internal audit. Now, internal audit, I'll talk about that a little bit later too. Internal audit is not audit going to work for PwC or E&Y. Internal audit is making sure that the company is following its own rules and regulations. And it's completely different than what you think of when you think of an audit company. Internal audit is a very different function. Human resources, hiring and firing, training, development, all right? Corporate services is a whole separate set of business in terms of managing office space, managing vendors. And so these are the support functions, and I'll get to them. And these are generally the revenue generating functions. I don't know, I should probably make these a different color so we can read them a little better. Stay with me. Oh, I'm getting the pinwheel of death. Now, bear with me for a second. Let's make these right yellow. All right. And again, I'm going to talk about these. We have sales and trading, which is just what it is. It's selling financial assets, stocks, bonds, securities, commodities, currencies to clients. Trading is managing those from a position standpoint. Asset management is managing other people's money as an investment. Investment banking, which is generally capital raising and corporate advising. Investment research, which is figuring out what companies are in what industries, how those industries are performing vis-a-vis each other, and how a company stacks up with an industry. And merchant banking, which I would argue is not like private equity, taking positions in the companies in which you're doing research. Anybody have any questions before we move on? All right, I'm looking at the window. I don't see anything there.
Nothing.
So
yeah.
I will take that as a no. Let's move on. Kara, is there anything you think I ought to add at this point?
This is great. I'm learning a lot too.
All right. So we talked about this a little bit last week, and this is part of the presentation that the Star Center actually has. And I left a lot of these slides in because I think they're very valuable. Pros, you get a lot of responsibility really quickly. It's interesting work. You work with really smart people. It's generally meritocratic, and there are clearly defined measures of success. You know how well you're doing, generally. And it's prestigious. Well, certainly was much more prestigious before the financial crisis. But it's still pretty prestigious, and the compensation is not bad. The cons, long hours. I worked 50 to 60-hour weeks for decades, and now that I'm an academic, sometimes I don't know what to do with the time. It's great. There's a lot of pressure. Some people thrive on pressure. I always did my best work when I had 20 things I had to get done. There can be an aggressive corporate culture. This varies a lot from firm to firm. A place like Goldman is known for its aggressive corporate culture. And the business cycle can move against you. And people sometimes lose their jobs when the market goes to hell and nobody wants to deal with these companies, because bank earnings move along with the economy. When the economy and the stock market are going down, generally banks don't do as well, and often they will let people go. So there are risks and rewards to doing this. But again, the good news is it's interesting. You work with smart people, and generally you're not underpaid. That has been my experience. So what are the key qualifications there? Interpersonal skills. Interpersonal skills are key. I teach a lot of quant courses, and the thing which distinguishes quants from a success standpoint is largely the extent to which they are able to express themselves clearly in spoken and written English. Very important, being able to communicate, having interpersonal skills. You have to network. You have to get to know people. Some people do it naturally. Some people have to kind of push themselves in that direction. They have to have self-confidence. They have to take the lead. They have to own the problem. All right. And they have to be able to handle high stress environments. If you're going to get crushed when things get tough, it's not a business you want to be in. Basic qualifications. I don't know about this. I mean, I'll let Kara speak to that. The 3.5. I didn't have a 3.5 when I was an undergrad, but I worked very hard. But regardless, internship experience helps. And one major reason internship experience helps is that when I see somebody that's had an internship, I know that they've proven to me that they have an interest in the business. So do I care whether somebody had an internship doing credit cards at Citibank or doing investment banking at Goldman Sachs? No, really I don't. Or if they had an internship doing investment banking at a tiny little regional investment bank in Tuscaloosa, Alabama? Nope, don't care. I'm more interested that you got the job, that you did well at the job, and that you show me that this is something you really thought about, and this is something you want to do. Very important is proving to me your interest. Because a lot of people, and I think I was one of these, I got caught up in the moment. One reason I want to do finance is a lot of my friends are doing finance, and it was fortunately, the more I heard about it, the more interesting it was. Now, I can't. A question came up with the minimum GPA requirements. I can't speak to that directly. I can tell you that when I look, my own heuristic when I'm looking at resumes is I look for a 3.0. And if you don't have a 3.0, maybe you don't want to put your GPA on the resume. I will defer to the Career Center on that.
Yeah, so some of the firms will post a minimum requirement. Typically, it's like a 3.2 or a 3.3. I've seen more frequently than a 3.5. I also always remind students it's the whole package. So the GPA is one piece of it. And I saw a question came in also about how do you compete with the requirements if you were working full time. Employers are looking at everything, and I'm sure Professor Abbott would agree. They're looking at your internship experience, your GPA, your extracurriculars, your leadership, your work experience, and they're looking at it all together. Also, how you present yourself on your resume, if it's well done, if there's no typos or errors. So don't focus on one piece. You want to highlight the areas that you've excelled in or that have been really meaningful for you. But if a company does post that they have like a minimum 3.2 and you don't meet it, sometimes they won't allow you to apply through the system.
Well, let me tell you a story though. I had a kid last year before last, who was an immigrant to the country. Neither of her parents went to college. I'm not sure her parents finished high school. She'd had some challenges. She took some time off. She's one of the most polished people I ever met. And she had worked in an accounting function without a college degree for a company. And I got a call from a friend of mine at B of A and said, we need some people with some raw skills. Can you introduce me? And she did not have the requisite GPA for the honors program. All right. She was below a 3.5, and she landed a job in a relatively senior position at Bank of America and made a boatload of money her first year. It was a story. She took time off. There's always a story. It's okay. Now, there's another question about better to get an MBA or CPA or MS before you start the job search. There are different opinions on this. Personally, I tell people no. Now, I know that Baruch will offer you a special deal if you go on and continue on, and that's fine. If you think that works for you, that's okay. My issue is when I went to grad school, it was 6 years after I finished undergrad, and I was highly motivated. I knew exactly why I wanted to go to grad school, and my experience was completely different because I was much more driven because I knew why I was spending all this time and money doing this. With a CPA and an MBA right after college, you don't know why you're doing it. You don't know what's important, what's not. You may spend all your time looking at municipal securities rulemaking board rules when I had to study that for one exam, but I've never used those even when I was in the muni desk. There's a lot of useless stuff you can learn that's not going to be, it's not going to be as useful to you. I ended up I did an economics program, then I did a quant program because I needed the quant background. And I was very motivated, but I knew why I wanted to do it. So it's very, very important to do that. Somebody asked the question, would you accept an offer for a company you're not interested in? If it's the right business and it's the only one you have, take it. That would be my advice to you. Your first job is in golf, and I don't play golf. I'm a musician. You can't be a musician and play golf. It's what we call a mulligan. It's a throwaway. If you do really well at your first job, great. If you do poorly at your first job and you hate it, you go do something different. Hey, when you interview for the second job, you say, I took this, I tried it, I worked really hard at it, I didn't like it. It's okay. I have never held a first job decision. Somebody went to work for Macy's for a year, discovered they didn't want to be a buyer. They wanted to be in banking. And then they told me why they'd be in banking. It was a good story. Hey, sold. No worries. Your first job, you get a mulligan. It's a throwaway if you want it to be. I tell people your first job should be A, to learn the lay of the land. What are the different types of companies and what do people do? And B, do I really want to be in this business? Or do I want to go to law school? Do I want to go get a PhD? Do I want to go work for a film company? That's what your first job is about. That is my opinion on that. All right. So let's talk a little bit about the types of businesses that are involved in this. So hold on. Let me just make sure I covered some. Oh, I didn't cover the technical stuff. Let me go through that. Technical knowledge of finance and accounting. It helps accounting. Accounting is painful for me. Gotta have it. Even on the quant side, I took 3 semesters of accounting, and to me, I'm so glad I did it. Was it boring and tedious? Oh yes. But it was tremendously useful throughout my career. And now with those 3 semesters of accounting, none of the accountants could put stuff in front of me that would totally lose me. I knew what was going on. I knew enough accounting with 3 semesters of accounting. 4 semesters probably be even better. It's not wasted time. Finance, no, stocks, bonds, CAPM, arbitrage pricing, a little bit of portfolio theory. That's what I find useful. Analytical and quantitative skills. I tell people, and there are different schools of thought on this, but I think it's really important to have some advanced quantitative skills. I like people that take a semester of linear algebra 2 semesters of calculus, a couple semesters of statistics. I found that to be useful. Again, painful. And look, I know I did a master's degree in statistics, and it was very painful, but tremendously useful. It made my career. And as a result of that, you gain knowledge of the analytical tools that you're required to know. Somebody says most companies want people with 1 to 3 years of experience. Where do you recommend you look for your first job? Wherever you think you can find one, that will be an interesting position. If you did mutual funds and then you want to go interview for investment banking, that's okay. When I looked at resumes and I was looking for interest, somebody to cover commodities, if I saw they did investment banking, that's okay. They want to cover commodities. I can understand that. If I saw that they worked for a civil engineering firm designing street signs that could be visible, then I kind of scratch my head and say, how can you prove to me that you're interested in finance if you work for a civil engineering company? That becomes a different story. Developing your story is much trickier there. So I hope that helps. All right. Knowledge of relevant analytical tools. I think the key thing is knowing how to ask the question when you're a junior person. Even when you're a senior person, you're going outside your area of expertise. I mean, I have a certain amount of statistical knowledge, and there are things, for me, the key thing was knowing where my knowledge stopped and when to bring in an expert. Never talking about things I didn't know about. So it's understanding the tools that are available to you. Knowing that when you're working with a portfolio, you might be dealing with portfolio optimization tools, and they use a certain kind of math. You have to know that math? Not necessarily. But you need to know that that's the kind of math that people do when they do that. When you're doing Black-Scholes, you're doing option pricing, you need to understand what is it about partial differential equations that makes this work. When I'm doing time series analysis to study market behavior, I need to be able to distinguish between volatile periods and quiet periods and the different tools I have that are out there. So a key thing is understanding the tools. It's almost like knowing what the difference is between a car, an SUV, a pickup truck, and a dump truck. And what, they're all internal combustion engines. You turn them on with a key. They have headlights. They can go fast or slow on the road, but they're used for different things. So you need to understand the tools that are at your disposal and how those tools can be used. All right. So talk a little bit about investment banking. Investment banking is primarily, not exclusively. Now, I want to distinguish first between investment banking and investment banks. Not everything that investment banks do is investment banking per se. And that's why I've broken this presentation into businesses and types of companies, because the investment banks are broad institutions that can do asset management, custody management, securities sales, securities trading, mutual funds, all kinds of different things. The investment banking function is primarily capital raising and advisory on mergers and acquisitions. Also, I would add private equity to that, and I'll talk a little bit about private equity. When I think about what an investment bank, investment banking as a business is, first, it's underwriting. Company wants to issue bonds, they want to issue stock. What should the price be? And there are many different analytical tools we use in assessing that. We do industry analysis, we look at the way the markets behave, but what are the options that are open? What types of bonds are out there? What types of stock offerings are there? How is it managed? How is an initial public offering managed versus a secondary offering? That's one very distinct piece. And also in that piece, very distinct bonds versus stocks. Equity capital markets is very different from debt capital markets, because in debt capital markets, we have high yield and high grade. And those are very, very, very different businesses. So the first thing that in investment banking is underwriting, allowing companies to raise money in the public securities market and sometimes in the private securities market. All right. The second thing is advising, mergers and acquisitions, LBO, which is, you can argue, a form of acquisition when the acquirer happens to be the management of the company, and restructuring of the company. So company A wants to expand in a particular business. How did they find a company that fits that, and how would they combine? Which business do they want to align themselves horizontally or vertically? Do they want to buy someone who supplies them with something or to whom they can supply something? Or do they want to buy somebody who's similar to them so they can gain economies of scale, economies of scope? Very different type of analysis. And then when you do that, there are different forms that M&A can take. It can be a merger. It can be an acquisition. There are different, and these are different legal formats, different types of transactions. Leveraged buyout is when the management borrows a lot of money to take the company private. So it's a reverse initial public offering. Those are structured in a very particular way. You spend a lot of time doing credit analysis on the cash flow of the company to make sure you understand whether they're going to have the cash to pay off the debt. And the debt often has covenants on it, which can be very restrictive. And then restructuring. The company wants to restructure itself. How might it do that? The skills, Excel is a presumption. PowerPoint helps also. With Excel, look, I'm teaching a business analytics course in the honors program this fall, and I'm going to spend a lot of time on Excel because you're going to learn it one way or another. You can either figure out how to do that funny graph at 11:45 at night because it's due the next morning at 7 when your boss comes in, or you can learn it in school, so it only takes you 5 minutes to do. But you have to learn how to use Excel. You have to learn the basics of Excel because it's so powerful in terms of what it can get done. The world changed completely when spreadsheets came out there. PowerPoint, and PowerPoint isn't just how do I turn on PowerPoint and how do I make a slide. It's how do you make a presentation. I would actually change it to PowerPoint presentation skills. And I have a whole separate thing on presentation skills we can talk about. Having witnessed thousands of presentations and having given thousands of presentations, I've got my own style tips on how to set these up. For example, no font smaller than 20, no more than 2 sentences in any bullet, usually only 1 sentence per bullet. There's a whole school of thought on how to make presentations make sense. Ability to work long hours. I confess to you, I never worked an 80-hour week. I worked multiple 60-hour plus weeks. Definitely. Actually, maybe when I was teaching, and at some point I was as America's Chief Risk Officer of Barclays, and I was teaching at 3 different places. Maybe some of those weeks I worked 80 hours a week. Not uncommon. But on the other hand, and I talked about this a couple weeks ago, you may really like that. I know I did. When I got my first big raise, I was like, wow, give me more work to do. It's 10 o'clock at night. No, I want more. And it's very satisfying. When you get a lot of stuff done, when you can learn how to work efficiently and detail oriented. You have to be ready to stand by the numbers that you create. All right. So this is a brief description of investment banking. We spend hours on this, and I spend a fair amount of time talking about this in this course I take. Private equity is a subset. Some people would say it's a subset of investment banking. Other people would say it's a subset of fund management because most private equity is done as part of a fund. And it's a whole different setup. Private equity is buying and selling companies that are not publicly traded. They're often owned by a small group of people or one person, and it's not listed on a public exchange. So they're funds and they're investors in those funds, and the investors in those funds rely on the fund investment company to invest in a number of smaller companies that aren't publicly traded. Now, why would you do this? Well, the stock market, you can get a dividend, you can get it, and in a good year, you can double your money in a very, very, very good year. With a diversified portfolio, it's going to be tough to do that. With a private equity portfolio, I'd be really, really disappointed if I made less than 20% per year. And in fact, if I invested a lot of money in private equity, I'm looking to make 100%, maybe 2 or 3 or 400%, depending on how much risk. Now, the fact that you can make that much means you can lose all your money. But I've seen many private equity investments return 400%. Now, it's a portfolio game because in private equity, for every 10 that make 200%, you're going to have one that loses everything. And I've seen that many times, and for any number of reasons. But it's a very different type of business. So here, institutions and retail. Well, retail, when I say retail, you're not going to get into a private equity fund for less than a couple $100,000, probably less than $500,000. You can't get it for less than $500,000. But institutions will do 100 million, 200 million, $1 billion. Pension funds will invest billions of dollars in private equities investments. In a private equity fund, the pension fund isn't going to buy the company. The pension fund is going to buy shares of a fund that invests in a portfolio of private companies. I sat on the investment and valuation committees for Morgan Stanley's private equity business, and I looked at dozens, probably hundreds of companies and their valuations, and I was part of the final decision-making process. By the time it got to us, it was mostly a sniff test as does this make sense? All the hard work was done by the analysts, but it's a very different business. Most employees have advanced degrees, many with MBAs, some have PhDs. Certainly an analyst in private equity is an interesting job to have, but you really need to understand corporate structure and strategy in order to understand how these businesses do well. Generally, private equity funds have limited partners who provide the capital. They usually own most of it, and a general partner who owns a small percentage and is the manager. So the general partner executes and operates the investment. All right. Any questions on investment banking or private equity? All right. I'm not seeing anything
right
come
now.
up. All right. Sales and trading is another business. Sorry, waiting for it to come up, which is not investment banking per se, but many investment banks have sales and trading operations. So where they directly face off with the markets. When we think of almost all investment banks, I think an M&A advisory firm might not have a sales and trading, but the big investment banks, Goldman Sachs, Morgan Stanley, and universal banks, Bank of America, Union Bank of Switzerland, they have sales and trading operations, and it's the distribution arm of the investment bank. And also for some banks, it's proprietary trading. Now, the Volcker Rule, which came out of the Dodd-Frank Act of 2010, prohibited banks from making proprietary investments subject to certain restrictions or make private equity investments. But there's still a lot of broker dealers can certainly do prop trading that banks couldn't do. Very different lifestyle than investment banking. When I worked on the trading side, I would, there's a question about investment banks and private equity. Private equity, different focus. When you're doing private equity, you're looking at should I buy this? Should I incorporate this small private company into my investment portfolio? Investment banking is a company needs to raise money or needs advice as to what company they want to buy. Very different company, but we can take that offline. All right, very different lifestyle than investment banking. When I worked in trading, I was generally at my desk by 7. And I generally got out at a decent hour because when the markets close, you close up the books, you can go home. But it's really, really intense during the day. It's a different thing. So when you're focused on the markets, you generally work market kind of hours. Skills, you got to understand finance. You got to understand financial markets. You have to want to look at Bloomberg every morning to understand why the markets are doing what they're doing. To my mind, you really need to find. I think I might have used this analogy last time. To be successful in the sales and trading business, you have to look at the markets the way an entomologist looks at an ant farm or a beehive. You just stand back and look and say, why are they doing that? What's driving this particular action? That to me is the key thing. Communication skills, always. You have to be able to articulate what's going on to people in clear, effective English. High energy helps because it's a very active marketplace, and tolerance of pressure. I'm telling you, oh boy. I spent, it's very high pressure. There's no better feeling than making a lot of money trading. There's no worse feeling than losing a lot of money trading. I can tell you that from personal experience. Do I think that positions will be gone because of logarithms? I don't think you mean logarithms, regulations or algorithms. It's hard to say. There'll always be somebody that needs to mind the store I think that we will continue to make advances in algorithmic trading, but there are portfolio decisions which can be aided by algorithm, but I think ultimately, to some extent, will require some kind of human supervision. That's what I think. I think there's only there's a certain amount that you can automate, and a certain amount needs to be done by people. That's what I think. So we talk about sales and trading. What are we talking about? So primarily, we're talking about 4 different product sets: commodities, foreign exchange, fixed income, and equities. There certainly may be others. You could argue bandwidth. There used to be. There's other. I would say 95 to 99% of sales and trading is taking place in these product categories. Oil liquids. So when I crack a barrel of crude oil, what do I get? I get light ends. I get gasoline. I get kerosene. I get fuel oil, jet fuel, fuel oil, and residual fuel. Oil liquids. And you could argue petrochemicals can be a part of that. Metals, base and precious. Aluminum, copper for base, gold, silver, platinum, precious. Agriculturals, wheat, corn, soybean oil, soybean meal, soybeans, live cattle, tiger shrimp, cheese, butter, eggs for smaller futures contracts. Largely, when we talk about ags, we're talking about wheat, corn, soybeans, pork bellies, live cattle, live hogs, a couple others. And if you go to Chicago Board of Trade, you'll see them listed as what the major ones are. All right. Nat gas and power, and I list them together because certainly in the U.S. and there are, a country like France relies very heavily on nuclear, and other countries have some access to renewables. But in the U.S., most power is provided through natural gas, and so there's a relationship between how much power you get from a certain amount of natural gas. That's called the spark spread. Between coal and power is called the dark spread. But that relationship, they're interchangeable. So when we talk about this, and it's a whole different complex, and these trade completely distinctly from oil liquids, I would argue. Foreign exchange, major currencies: dollar, yen, euro, pound, Aussie, Kiwi, Canada. Those are the major currencies and the relationships between them. Most of them are traded against dollar. There are a couple of what we call the major crosses. Euro sterling would be one of the major crosses. Euro yen would be another. Pound yen would be another one. All right. But so those are the majors. Minors would be currencies. A lot of certain Latin American currencies would be considered minor. I think you'd probably put renminbi there, even though it's a huge country. The currency doesn't trade like a very liquid currency. There are a lot of government controls there. And exotics are small countries: Azerbaijan, the Kazakh tenge, the Peruvian sol, for example. Not a lot of liquidity there. Fixed income, we have a variety of different types of instruments are traded. They're all bonds. They all have coupons. They all pay interest from time to time, but they're different, very different instruments. You've got treasuries, which are liabilities that are issued by the U.S. Treasury. High yield, companies with low credit ratings. These can trade completely different than high grade bonds that are triple B, double A, single A, and triple A in terms of the credit quality. Different market. Municipals, which are bonds issued by states and local governments. Sovereigns, non-country bonds issued by governments outside the U.S. In the UK, they're called gilts. In France, they're oats and B10s. They've got a different name in Bundesbobels, Posts, and Cassens in Germany. Different set of names in different countries. And emerging markets. So emerging market countries often issue sovereign bonds, and they trade in a very separate market. In equities, generally it's delta one, which means it's like trading a stock or trading a stock directly, or trading something that behaves just like a stock, or trading some kind of option. And there are many different types of, there are volatility options, there are options, there are puts, there are calls. It's a whole separate thing. I spend a lot of time in my class talking about the difference between these. There's prop and there's flow. A prop isn't done too much anymore in the equities. It's buying and selling for your own account to make money because you bought low and sold high, or sold high and bought low, versus flow, which is customer trading. So you're buying and selling, you're making markets for your clients. You're out there buying on behalf of your clients, or you're maintaining an inventory. So these are very, very different types of business. And we can certainly spend a lot of time talking. This is where I spent most of my career. I covered all these at some point in time. I loved commodities. I've actually been out to a lot of different commodity areas to see it. Any questions on sales and trading before I move on?
One came through to me. Is fixed income trading more complex or harder than equities, especially now that rates are so low?
I wouldn't say it's more complex. I think you could argue that each of them have their varying levels of complexity. When you're talking about corporates, you've got a whole different set of risks that are there, which is the company going to default? Now, it's in a really bad year, high yield bonds as a class default at about a 4% rate. So 96% of high yield bonds won't default in any given year. It's much lower. The default rates are much lower in high grade bonds. A AA bond historically has a 0.02% probability of default based on history. There are lots of analysis that are done here. So when you start going from treasuries, which supposedly have zero risk, countries are not supposed to have risk, because if a country gets in trouble, they can always print more money. Unless you're Russia and you default on local currency debt. But Russia, it's like those internet memes. Meanwhile, in Russia, Russia lives on planet Russia, and they do their own thing. It's really hard to describe or understand what goes on there. But countries aren't supposed to default on local currency debt because they can print more currency. So we don't spend that much time worrying about country risk. Although there is a probability, even in the U.S., that a country could default because there's some kind of political issue and the Congress doesn't approve the budget. We've had a couple of standoffs in the past 10 years where the U.S. while the U.S. has the money, they might default, which is to say they didn't make the payment on time because there's some political thing that got in the way. It's a whole different type of analysis. And when we talk about country risk, we're talking about sovereigns and emerging market debt, and this could be country debt or this could be company debt. You have to put currency restrictions involved. There are a whole bunch of other things that are involved. We think about that. Municipal is a separate market. Municipal bonds are tax exempt at the federal level, so they trade very differently, and they're held by, most munis are held by mom and pop in mutual funds. A lot of this is held by others are held by institutional investors. Very different market. Very different. In fact, you'll find people that can move from one fixed income area to another fixed income area. You don't see much crossover, people going from fixed income to equities to fixed income. In my experience, people typically specialize. I've seen a lot of people go from fixed income to commodities. I don't see a lot of people go from commodities to fixed income. I have seen it done. Often fixed income covers foreign exchange, and sometimes it includes, there's fixed income currencies and commodities, but it varies. Equities is always separate. Delta one, somebody asked a question about Delta one. When we talk about Delta one, generally it's cash equities. It could be other things that have prices that move like equities, like total return swaps, for example. But mostly when we talk about Delta one, we're talking about largely cash equities. Buying and selling stocks, or things that behave like stocks. ETFs, for example. All right. All right. Wealth management is a whole separate business. Wealth management is basically providing investment advisory services for wealthy people. Now, wealthy people fall into several different categories. There's the mass affluent, with maybe up to $500,000 to invest. High net worth individuals with up to like $1 million, $2 million to invest. very high net worth individuals, anywhere from 2 to 20 million to invest, and ultra high net worth individuals with north of 20 million to invest. Some people with ultra high net worth at 40 million to invest. So a high net worth individual wants to be able to make the right investment for his daughter's college fund. A very high net worth individual might be managing money so they can buy a second home or another Audi S8. All right. A ultra high net worth person wants to buy a Picasso for $4 million and probably has 2 or 3 yachts and a villa on the French Riviera. So their needs are very different. How they borrow money and what they use as collateral. There are people that use art as collateral. How do you judge that? It's a whole different thing. These people need credentialed financial advisory specialists they can call on. And why is it different than a fund? Well, because when you're dealing with an individual, you have to coordinate their retail banking. So the person, they might have 10 million in the account, but they need a checking account. They need a savings account. They need to be able to shift money back and forth. And they don't want to wait in line at the teller. Estate planning. How do I pass this money on to my children without triggering taxes? Legal resources. How do I make sure I'm setting up myself in such a way that I'm not paying any more tax than I need to pay? Do I want some of this offshore? Do I want to keep it onshore? How do I minimize my tax bill while still remaining in the confines of the law? Tax planning is a very big part of it. And investment management. Do I want to have my money largely in stock or largely in bonds? When you're young, the equity market over the long term outperforms all other markets. It just has over centuries. But as you get older, your tolerance for loss changes because your time frame changes. When I was 30, my investment horizon was 40, maybe 50 years. So I was willing to take risks because I knew over the long run I'd make the money. Well, now I'm a little older. I'm almost 60. I don't have a 30-year time frame anymore. I have a 10-year time frame. Just as coronavirus, I'd still taken a rather aggressive position. I was 70% equities, 30% everything else, which is a very aggressive position, and it served me very well for a long period of time. But when coronavirus hit, I changed that to 30-70. I repositioned. Now, because I spent so much time in the business, I didn't feel the need to go to an investment manager for this advice. I'm not going to pay somebody 2 or 3% to make decisions that I should make because I spent my whole career doing this. But understanding how to make those decisions for people that have money to invest is very important. And again, so estate planning, business succession, stock option planning, hedging for large blocks of stock. If somebody owns a large block of stock, they want to hedge their position. How do they do that? They demand a greater level of service. Again, you don't want to wait in line at Bank of America if you've got $20 million in their account. You want a special service. You want them to serve you crudité and maybe offer you a glass of champagne when you sit down if you're keeping that kind of coin there. And the products that people buy are very, very different. There's been a huge increase in affluent investors, so there's been a much greater demand for more sophisticated solutions. It used to be just put your money in the bank, you bought some stocks, but now there are people that can help you structure a portfolio. And now you've got automated processes that do this on the wealth management side that are taking artificial intelligence into consideration. So it's a very different business. So the primary difference with individuals versus corporates are time horizons. Companies can exist for hundreds of years. Individuals, what's their life expectancy? 70, 80. So you have to manage over a shorter period of time, and you have to have tax efficient asset transfer strategies. And individuals face different taxes by locality, and investment strategists have to take that in consideration. All right. When we think about corporate banking, generally, not specifically, but generally, we're talking about making loans and how do we do this business and how do we make loans and who does that? And that is largely a credit intensive business where you're looking at you're looking at a company, not financial institutions. You're looking at companies' balance sheets and making the assessment as to whether or not they can handle the amount of debt which is being proposed for them to take on. And so being a lending officer is making those decisions. And this is all part of the credit process, which I'll talk about next time. And so you got loans, you got cash management services, you got leasing, commercial real estate, right? Trade finance. So if somebody wants to finance their receivables from doing international trade. And they offer services through their investment banks as well. So a lot of it is, when we talk about corporate banking, we're talking about how do we provide debt through bank loans as opposed to bonds to companies. And I would argue that that is the key part here. Now we're just about at an hour, so I think I'm going to stop here. Next time we meet, assuming there's interest, what I will do is I'll cover the key control functions. This is taken, parts of this are taken from, I'll just give a quick preview of that. And I'll post this presentation.
We had you till 2:30.
Oh, okay. Then I'll spend some time going through the control functions. All right. For every, did I lose anyone? Let's see, how many people do we still have?
45.
45. Oh, we've increased. How about that? Yeah. All right. For every front office job, lender, trader, wealth manager, investment banker, there are anywhere between 2.5 and 10 support functions. People doing supporting jobs that facilitate that business. I've spent some of my career in the front office. I spent most of my career in the middle and in the back office, and there are plenty of excellent jobs to be had there. So I'll talk a little bit about the ones. And again, I've got a whole course on control functions that I teach in the fall. So first I'm going to talk about risk management, because that's where I spent a lot of my career. Market risk, credit risk, operational risk. Market risk focuses on how much you can lose in a stock, a bond, a derivative, a currency, commodity, a structured product, based on how the market moves. The focus is generally relatively short term, anywhere from 5 minutes to 5 days to maybe 5 weeks. But the time horizon is and the metrics are focused on relatively short-term measures of risk. The presumption is that we can get out of these instruments within a week or two, and that we can hedge them. All right. So again, securities, which are stocks and bonds, commodities, which can be cash or derivatives. Stocks and bonds also can be cash or derivatives. Currencies, all right, and equities. Well, I talked about equities as part of securities. How do their prices move? I think of it as this understanding the statistics of the market and the portfolio of the bank, and how we can make sure that senior management is fully aware of the risk profile of the trading book of the bank. That, to me, is the very definition of market risk. Often, not always, often tied to the sales and trading portion of the business. Certainly, if you're on the buy side, there are, in a mutual fund, they're going to have risk management group. They're going to have different kinds of metrics that they look at. But this is something, this is most often part of the sales and trading part of the business. Key skills, highly analytical. You got to have, generally quantitative analysis comes generally, not exclusively, generally in two flavors, either partial differential equations in terms of being able to price contingent claims, which are options, or understanding statistics, time series, econometrics. Those kinds of skills are very valuable. Computers and computer programming. Now, I haven't programmed in 30 years, but I did program for a while, and I learned a lot about what good code is and why it's important to do that. So now, understanding SQL in terms of a structured query language, C++, Python, R, all these languages that are out there. People who do market risk usually end up spending a lot of time doing Microsoft Excel. Just an important part of the business. Any questions on market risk? I'll wait 10 seconds before that comes up.
Nothing on market risk. We just got a couple of other questions previously.
Yeah, I think I got those, at least the ones I see. Are there any that I don't see that were sent to you that you want to ask me?
No, that's it.
All right. Credit risk looks at people or companies that owe us money and the probability that they're going to pay us back. Now, when somebody owes us money, they might fail to pay us back for one of two reasons. Either they're unable, they don't have the cash, or they're unwilling. Sometimes they're unwilling just because they're jerks. Sometimes they're unwilling because they think they've been cheated and the documentation says that. Sometimes they're unwilling because they don't think that they owe money based on their read of the contract. And so credit risk is making sure that your claims against somebody are good and well understood and aggregated and reported. Now, when you aggregate credit risk, how do you do that? Do you do it based on outstandings? Well, the credit risk of a 1 month bond, the overnight credit risk of lending money to somebody, or there's 1 day credit risk, 1 month credit risk, 1 year credit risk. Those are very different types of risks. And there's whether or not I have collateral, and how do I manage that collateral? There's understanding that I may be lending to 10 different subsidiaries of a company. So when I say, when I look at JP Morgan, I'm not just looking at JP Morgan Bank. I'm looking at JP Morgan Securities. I'm looking at JP Morgan Asset Management. I'm looking at all the different subsidiaries and untangling those exposures to understand how that risk aggregates into a whole, an understandable whole. Now, responsibilities are evaluating company industry fundamentals, projecting earnings, projecting cash flows, and understanding the probabilities of default. As I mentioned before, high yield bonds in general and a bad yield default at a 4% clip. AAA bonds, haven't seen a company in last 100 years, in known history, certainly of which I'm aware, that having had a AAA rating at the beginning of a year was in default by the end of the year. I only know of one instance where a company was AA and then defaulted within a year, and that's Enron. It's 2001, 2002. So still, even with single A bonds, you're talking about under 1/2 of 1% of these are going to get in trouble over a particular year. But understanding that. Also understanding how those risks come about. There are fundamentally 2, maybe 3 different ways somebody can owe you money. Either you've lent them money and they need to pay you back through a bond or a loan, or something like counterparty risk. Now, the best analogy to counterparty risk is if I'm betting with any of you on the spread of a basketball game. In reality, it's on the price of a security or a commodity or stock or bond, all right? But I'm betting with you on the spread of a basketball game. At the start of the game, it's 0. Throughout the game, I can owe you, you can owe me, maybe it's $10 a point. At some point, risk has been generated because you owe me money and you haven't paid back. I haven't lent you money per se, but we've agreed on a trade and the trade has made money for me. You owe me that money. Are you going to pay me back? In terms of the liability, it's just a sound of liability. You could put somebody in bankruptcy because you lent them money and didn't pay you back, or you could put somebody in bankruptcy, they owe you money on a transaction, like the spread of a basketball game, for example, and they didn't pay you back. There's also a type of risk called settlement risk, which I would argue is counterparty risk, where I agree to sell euro to you and I'm going to pay you dollars, and I wire the dollars into your fund, into your account, and you haven't paid me my euro yet. It may only take 2 or 3 or 5 minutes, but how do I know that money's coming in? I would argue that's a type of counterparty risk. Not everybody necessarily agrees with me on that, but that's okay. So we talk about credit risk, we're talking about issuer risk and counterparty risk. We're talking willingness or ability to pay us back. We're talking primarily through bonds, loans, or derivative transactions. Does that make sense? Anyone? Any questions on credit risk? I do an entire lecture on credit risk because a lot of people get involved with credit. All right, I will take that as a no. Next one, operational risk. Operational risk is a requirement of Basel II. If you look in the lower left of this, lower right, sorry, other left. Give me a second while I full screen this. This is the amount of assets by the type of risk taken by a major company. This is 2018, but it hasn't changed that much. At most financial institutions, big financial institutions, the bulk of the risk is credit risk. Loans, bonds, derivatives. Most of the risk that Citigroup and Goldman take is credit risk. The second highest amount of risk is not trading risk, market risk, even at Goldman Sachs and Morgan Stanley, which are the big trading houses. The second biggest source of risk is operational risk. And operational risk is the likelihood of loss from failed people, failed process, bad luck, bad weather. You can have failed process, you can have damage to physical assets, internal fraud, external fraud. You can have losses from process management. You can have losses from angering your customers. They're all different types of ways you can lose money. And we think about these losses in an actuarial sense. We can estimate probability and severity when we do this. And there are many highly analytical techniques that do this. A lot of it is very process oriented, but some elements are very, very, very quantitative. The key risks, the key tasks involve the key risk indicators. So we come up with dashboards. One of the things we want to know is, are we running hot or are we running cold? How many securities are we trading? What is the volume? How many fails? How many operational errors do we have? How many times did the systems fail? How many times did people not complete their training? How many times did we have somebody do a trade they weren't supposed to do or break through a limit? Risk control self-assessment is another thing that goes on. Companies do a very detailed self-assessment of where they are taking risk. And it's a very detailed questionnaire that most parts of companies have to go through. Certainly all banks have to do it, and many other types of firms as well. SA is scenario analysis. So scenario analysis is a highly detailed self-assessment on a business by business basis where we're going with senior management of equities and say, let's talk about all the ways, the very low probability ways you could lose business. Do you have any probability of fraud? Do you have any systems failure? How often did it happen? And how much did you lose when it did happen? Policies and procedures and loss analysis. When we lose money because a system failed, whose fault was it? What happened? Anytime you lose money that isn't from market risk or credit risk, you record that loss and you define what happened because you need to track that. And again, the second biggest source of losses for big banks is not trading losses. It's operational screw-ups. And a lot of it is retail losses because you screwed up with your customers. You didn't provide them payments on time. You violated some kind of covenant with them. You broke some kind of rule. You didn't manage the money right. Huge losses can come about here. Sometimes it's bad luck. Sometimes companies 10 years ago had huge losses, 9 years ago, because of Superstorm Sandy. Why was that? Well, all of Lower Manhattan flooded. You guys were not even in high school then, for the most part. But a lot of banks, particularly on Water Street, had their computer systems in the basement. Well, Lower Manhattan was generally under 4 feet of water. Guess what? All the systems went bad. That's when companies started having all their supporting operations out in New Jersey and started moving things around so they could get things that are not centralized in Manhattan. September 11th, the whole payment system almost failed because the wiring was down. How do you measure that risk? Legal risk, because you got people that are breaking the rules, that are doing insider trading, that are hosing their customers. How do you assess that? Operational risk takes a studied view of how that takes place and how it can be prevented. There's a lot more in this, but these are the categories: internal fraud, external fraud, employment practice and workplace safety. So did I shovel my sidewalk, or did I fail to shovel my sidewalk and 3 people fell down, broke their legs, and are suing me for $1 billion? Employment practices, do I discriminate? There's a huge source of loss. A lot of this is going to be lawsuits, people that are not doing the right thing. Clients, products, and business practices. Am I abusing my clients? Am I selling bad products? Am I selling toxic derivatives that companies are losing a lot of money on? Damage to physical assets. Did I have my computer systems in the basement? Business disruption, system failure. Did a storm stop it? And there's overlap between these. Execution, delivery, and process management. You've got a lot of banks that are very big and very complex and can't manage themselves because they're too big to manage. So this is a whole separate area in risk management. Anybody, questions or comments? All right, I will take that as a no. Hold on.
Nothing on my end.
All right, finance. Finance, in the context of a support function, finance means accounting. Finance generally 4 separate roles. Commentator. What happened? Why did it happen? Did we make money? Did we lose money? Why? Where did we lose money? Where do we make money? Where are expenses going up? Where are expenses going down? Where and how do I measure and manage that? Business partner. How do I structure my business? How do I structure my business to make as much money as I can possibly make as a business partner? Scorekeeper. Focus on bookkeepers. Are my numbers right? Do I have faith in my numbers? And custodian. Governance. Is everybody doing what they're supposed to do? Now, this is not the list of roles within finance, not limited necessarily to this, but you got financial control, which is books and records, financial reporting, external reporting to the public and to regulators, BP&A, business planning and analytics. How do I do budgeting? How do I do forecasting? How do I do control costs? There are a lot of positions in BP&A. Accounting policy. How do I account for a particular thing? How do I make sure I got the accounting rules right? Regulatory policy. How do I make sure I'm following the regulatory rules on that? Treasury, and treasury is often seen as a whole separate, it's usually housed within finance, but how do I manage money inside the company to make sure I always have enough cash on hand? You could be very wealthy, but cash poor, not having the cash to pay the money coming to, and you be put out of business. Investor relations, often part of that. The CFO, which is a whole separate function, the chief financial officer. How do I make sure that that tax is being done right, and product control, which is related to financial control. All right, so when we talk about finance within banking, we're generally talking about the accounting function. Anyone, questions or comments? We still have 40 plus people, or am I boring them yet?
Nope, we do.
Wow. All right, that's good. All right, let me just the problem with Zoom is I can't. Oh, actually, move the nameplates down here. Oh. Internal audit. Internal audit is not well understood. Most people, when they think of audit, they think of E&Y or PwC or KPMG. Internal audit is not E&Y, PwC, KPMG. Internal audit is a function that provides assurance to senior management that they were doing the stuff we're supposed to do. I should not just senior management, also the board, regulators, other stakeholders. And the job is to make sure that people are following policy and procedure, that they're doing the things they said they were going to do, that their processes work. So if you say you're in risk management, you're validating models, how do we know you validated all the models? Show me a list of all the models. Show me all the model validation documents. Show me the dates on which you completed those model validation documents. Show me all the models that were used and prove to me that none were used before the validation was complete. Show me that when you committed to fix something by June 30th, that it was in fact fixed on June 30th. Show me that when you committed to have a meeting with the appropriate people to talk about the problems in a certain business, that you had that meeting. Show me the minutes in that meeting. So in general, they assess the adequacy of the internal control environment and the risk management systems. And I would say largely it's how to maintain an effective internal control environment to minimize risk. It's a very big job, a very important job. And politically, it can be challenging. Admittedly, when I was very, very senior and was very, very close to leaving, I thought about taking a job in audit because I could be a pain to people and I had nothing to, and no political stake in the game. And it's very interesting. You see everything in audit. It's a great place to start. You see everything in audit. So you look at the adequacy and effective risk management, controls, governance. Controls, how are you measuring things? How do you know that your measurements are accurate? Governance, show me your policies, your procedures, your frameworks. Show me your committee structures. Are you taking minutes? Are people showing up to the meetings? How do you know that you're complying with the laws and the regulations? They provide recommendations for improvement, and they help detect fraud. So internal audit is, again, a very, very, very different function than audit, like working for an accounting firm. Internal audit, very, very different. Any questions or comments? All right. General question. Let's see. What is the main topic of my Fin 283 course? The course is called Control Functions. You look it up on CUNY first, it's there. My understanding, I don't know, somebody asked whether it's going to be online in the fall. I don't know exactly what CUNY has planned. I am assuming that at best, these courses are going to be hybrid courses. I can't imagine that we're going to have, and it's as much for the professors as for the students, but it's for everybody, particularly at a school where a lot of people commute. Are the subways safe? I'm not sure the subways are safe. I have no reason to think they're not, but I don't know. And it's even more important for the professors than for the students, because a lot of professors are over 60 and they're at risk. So my presumption is that at least part of all the courses are going to be online, and we're all learning how to do this better. All right. So Benjamin, I hope that answers your question. If you have other questions, you guys can email me. I'm happy to answer questions. Audit. Human resources. Human resources is a whole separate function, and the idea of human resources, how do we make sure that we attract the right people, we hire them according to the right rules, we don't discriminate, we hire a diverse workforce? How do we make sure that once we have them, that we keep them, that they don't leave? How do we make sure that they're performing at the right level and they're meeting the organization's goals? So generally 5 different things. Recruitment and selection. Where do I start to look for people? Once I found the right people to interview, how do I go about picking the right people? And this one reason I would argue that a key reason that companies have summer internships is not because you're gonna change the world by doing your summer internship project, is they get to try before they buy. The more money they spend on summer internships, the less money they spend on recruiting, because they're gonna hire 3/4 of their class every year based on the internships. So once we found the right people, how do we train them? What kinds of classes do they need to take? They need in-person classes, they need online classes, they need regulatory training classes. That's a big requirement. Another thing is in terms of development. So I've got a lot of people leave because they don't think they're getting the career opportunities that they want to get. So how do you give people career paths that they can see that they go from investment banking analyst to whatever it is after investment banking analyst? And somebody asked, if you're just an investment banking business, but you receive an offer for a department that isn't related to what you do, I'd probably take it if I'm an analyst just to get my foot in the door and understand what the company does. Do a good job. If you do a good job, you get a chance to look around. I've helped a lot of people get jobs. You look at my professor stuff, you'll see people say that. I'm not saying that to boast, well, maybe a little bit. But I generally tell people that I've helped get jobs. I expect you to spend 2 years in that job, that first job, unless you hate it. And I spent a year in my first job, and I got a much better job after that. But when I help someone get a job, because it makes me look bad if you stay for 3 months and you leave. I had a woman I helped get a job, very good job, and she's being called by headhunters. And I said, look, at the end of the day, you got to do what's right for you. But my hope is that you'd stay there 2 years. She's been there a year now, so I figured now after a year and a half, she's more or less a free agent. So how do we train them? How do we develop them? How do we make so that our best analysts stick around to become associates, and our best associates stick around to become vice presidents, and our best vice presidents stick around to become directors, and our best directors stick around to become managing directors? How do we find career paths? How do we do performance appraisal? Who did well, who did not? How do we link the compensation to that? So how do we track that? If somebody's doing badly, we have to record very carefully what they're doing and why that's a problem and how they can improve it. Or we can get in big trouble with the government for firing people without cause. How do we provide that feedback? Is it written? Is it in meetings? What's the right way to do that? Human resources coordinates that. How much do people get paid and what kind of benefits they have? Benefits are something like 25% of total compensation. Medical, all right, for example, dental, vision care. Having access to this is huge, and it's managed out of human resources. How much do people get paid? I spent a fair amount of time, I talked about this a little bit last time, how much people get paid. How do you benchmark people against their peers, either at your own company or at different companies? That's an important part of what human resources does. And labor relationships, when people are having problems, how do we deal with it? If somebody has a gripe, how do they record that? Compliance. Now there's general compliance and there's specialist compliance. General compliance, lending laws, so there's Truth in Lending Act. There's all kinds of rules about usury and what rate of interest you can charge and how you make sure the documentation is clear. Brokerage requirements. How do you make sure that you're meeting all the rules that Securities Exchange Commission sets? Rules about compensation. If I'm going to be trading or doing sales, people have to have the right licenses, and you have to do all kinds of regulatory reporting. Specialist compliance is anti-money laundering, counter-terrorist, all kinds of rules with respect to private banking and wealth management, tracking derivatives, technical risk management, and conduct. Whole separate field. Used to be largely lawyers, increasingly well beyond that. So compliance is a whole separate field within this area. Anybody questions on those two? I'll take that as a no.
No, nothing.
All right, it is now, let me see. Here's where I start to get. Yep. Research aggregates information. They provide it as a service to clients. Now, this has changed hugely over the past 10 years because it used to be you'd want to do business with a company and so you'd do a good research report about them. Now it's got to be more arm's length. But doing fundamental research, and I got one of my research friends to talk to people a couple of months ago about what he does. Economists are often part of the research function. How do we estimate, how companies are doing? We write reports about the metals and mining industry, about the oil industry. You have that kind of expertise in-house. The research people are typically the kind of do that. So sometimes they'll come up with their own ideas. You should buy this sector, sell this sector. Sometimes they'll help you manage the portfolio. And sometimes they'll just, if you're on the buy side, you have the research function say, what companies are the best companies to buy in this particular sector? So this is very highly analytical job. You have to spend a lot of time reading financial statements, understanding markets. Key skills, verbal, written communication, Excel, financial modeling. You have to be inquisitive, I would say there. All right. I think I'm going to end it here. I'll take a couple questions. There are a couple things here, recruiter timelines, core school model. Well, we're changing that. Baruch I've helped place people in the last 6 months, Credit Suisse, JP Morgan, Morgan Stanley, Goldman Sachs. You are not at a disadvantage because you didn't go to Yale or go to Middlebury. I'm telling you that. Do a good job at Baruch, and you are as marketable as anyone. I can tell you that because Credit Suisse reached out to me. They said, we hear good things about Baruch. We want to hire somebody. Well, I got some students together and they hired somebody who's got a summer job next year. Somebody just reached out to me from Citibank. Ken, I've known you for a long time. I know you're teaching now. Help me find some good people. I need to hire a bunch of people. All right. So this idea of the core school, just because you go to CUNY doesn't mean you're not just as marketable as anyone else. Keep that in mind. Conversion of summer intern, this is a key recruiting tool. Because again, I mentioned that before. That's what companies want to do. So search out internships, keep your grades up, network, get to know people. You get there, make calls. Make sure you join in other finance-related activities. And I talked about this a lot of time. Read the newspaper. Make sure you know what every article in the Wall Street Journal is about. You don't have to read every article, but make sure you know topically what's going on. And always get ready for interviews. And I'm always happy to talk to people about that. All right, I think I'm going to end it there. You guys know how to reach me. I'm around. Kara, if you want me to go into more detail, I have another thing that shortly after this section, let me find it. Sorry, I'm getting the pinwheel of death. Oh, my screen sharing's paused. Did my screen go blank?
No.
All right.
Why don't I put it into the chat box for those of you here. If you could type in, did this seem to cover all of the questions you had, or would you be interested in a part 3 that went into more?
Because what I would do is I'd talk about financial institutions, where I'd talk about, here, I'll show you what the third part of this. Banks, thrifts, credit unions, broker-dealers, mutual funds, hedge funds, private equity, life insurance, property casualty, mortgage company, finance company, exchange, clearinghouse.
Okay.
These are all very different types of companies.
Looks like we're getting a lot of comments for part 3. So we'll look to set that up.
Kara, come up with a couple dates. I know you may not be around. You should enjoy the rest of your summer to the extent you can with little kids running around the house. I fully appreciate. Well, my kids are older now, but it's complex.
Keeps you busy.
I will post these slides. I'll send them to you, Kara, and you can post them.
You know, we don't typically share our slides from the Career Center, so what we would suggest is we'll put the video up on YouTube as quickly as possible, and you can get everything on there.
All right, very good. All right, everyone. So maybe we'll do it in a couple weeks. You let me know, Kara, what works. I'm around, and I'll make the time. If any have questions, some of you reach out to me. I'm happy to chat with you. So feel free to reach out to me. If you don't hear from me right away, persist. I get a lot of emails. I'm happy to answer your questions. I already talked to a bunch of you.
Well, thank you everyone then for coming, and look out for the part 3. Hopefully we'll be able to pull that off in the next maybe 2 weeks or so. So just make sure you check our Star Weekly and look for the flyer so that you have that information. And also the YouTube video will be up soon.
Good.
And thank you, Ken, so much for giving the time and for sharing all of this really useful information for students. I know I myself learned a lot as well, so hopefully I can be more helpful to them.
My pleasure. Anytime. All right. Take care, everyone.